Well, thanks everyone who dialed into this webinar. We know webinars are not super exciting and tax topics are also not super exciting, but Walter, Chris, and I are going to make this presentation as practical, useful, and interesting as as we can, and we think it's a very timely and interesting topic. And we thank those folks who submitted questions in advance. We have a section of the presentation is dedicated to answering your pre-submitted questions, because again, we want this to be useful to you and not just an overview of the law that you could have read from any number of sources. So the topic du jour is pass-through entity taxes. The pass-through entity taxes are unique in that their goal is to save taxpayers money. It is a tax that is actually designed to be helpful to residents of that state. So it's sort of a quirky history to it or rationale to it, but that understanding is going to be useful when you think about how these rules apply in practice. It is not like a tax incentive that is a very narrow scope that only applies to taxpayers with AGI below a certain threshold, or that operate in a very narrow segment of the economy. These are intended to be helpful to residents, and as a result, the New York one in particular was drafted broadly, and it applies to individuals that own interest in a pass-through entity. That is many folks. If you are a fund manager or a partner in a fund and you have carry, the carry is an interest in a pass-through entity. It's a profits interest. It's a partnership interest. If you're a celebrity that has gotten a profits interest for a venture that you've participated in, that profits interest is an interest in a pass-through entity. Small business owners that conduct their business through a S corporation or an LLC, pass-through entities, and even the folks on this call that are the accountants and the lawyers often are members of personal service firms that work through pass-through entities or work for pass-through entities. So this topic has broad application, and it's intended to be helpful to residents. So it is, I think, a very it is a topic that is going to be good to know about, given that we have an election due October 15th of this year to avail oneself of the benefits for 2021 of the pass-through entity tax, and that in March 2022 is the election to elect into the program for the following year. So decisions are going to have to be made very quickly, and we're going to walk through the analysis of what one needs to undertake in order to properly evaluate whether or not to participate in the program. So very quickly, the background. My name is Michael Bloom. I'm a tax partner at Venable. I've been with the firm since 2007. Presenting with me today is Walter Calvert, who is the head of our firm's SALT practice, was recently elected a fellow of the American College of Tax Counsel, which is a very prestigious designation. Walter is a very prestigious individual. And we have Chris Moran, who is named a Super Lawyer Rising Star and one to watch by Best Lawyers in America for 2021. Chris is a great associate. Really enjoyed working with these folks. And so we hope that you will enjoy this presentation today. So let's begin. Here's what we're going to cover. We have 5 general topics. We have the SALT cap problem. What is the issue that the pass-through entity tax or the SALT workaround in New York is designed to solve? Okay, how is Section 2, a partial SALT cap solution, pass-through entity taxes? How is a pass-through entity tax a solution to the SALT cap problem? Explain how those work together. And then Section 3, New York's pass-through entity tax. How does it work? How do I elect in? What are the deadlines? Who does it apply to? all of these pass-through entity taxes are different. You can't assume that if you understand New York's, you're going to understand Connecticut's or California's or vice versa. Each one has to be analyzed separately. And so we're going to walk through specifically, this program is designed for the New York one. And Section D will highlight some of the big differences that we've seen between pass-through entity programs enacted by the states. And Walter's going to talk more specifically about that. Section 4 is pre-submitted questions. Again, thanks for those who submitted questions. And then lastly is the legislative update. Where are we going with this? Because this is a moving target. Congress and Democrats, specifically in Congress, are some of them are working to repeal the SALT cap for those who represent high income taxpayers, mostly in blue states. Different proposals to repeal it have been enacted. And so, to get a sense of planning, you also think about where are we going? So that's what Section 5 is going to cover. So the SALT cap problem, just very quickly, most of the folks know this already, which is why they're dialed in. But the Tax Cuts and Jobs Act 2017 limited an individual's ability to deduct state and local taxes to $10,000. Well, for people in high tax states, capping this deduction can be and was material. It caused a significant increase in their federal income taxes. Let's look at just a basic example. Simple example for a high net worth individual in New York. Let's say this person has $1.5 million of taxable income. New York State income tax rate 6.85% on that amount. This person lives in Westchester, pays real estate taxes of $40,000. So at a $142,000 total possible deduction for state and local taxes is now capped at $10,000. And what would have been the economic benefit of being able to deduct that $132,000 excess? Well, about $50,000 a year. So this cap has a significant impact to high net worth individuals. And again, note that we're assuming this taxpayer was paying regular tax before the Tax Cuts and Jobs Act, not AMT. As most folks know, AMT had an add back for state and local tax deductions. But many folks, notwithstanding that add back, were still paying regular income tax. And that's what this slide simply highlights. When talking about this topic, some people might sort of brush it off and say, well, is this really a big deal? Because, AMT caught taxpayers and AMT didn't allow you to deduct state and local taxes anyway. So what's the big deal? Well, for some people, there really isn't a big deal because they weren't getting the full SALT deduction anyway. But for a lot of folks, it is a big deal that we're paying regular income taxes before 2018. And we know that because right now they're talking about in Congress how much is it going to cost to remove the SALT cap, and it's a huge revenue raiser, meaning that it has a big tax increase effect of approximately by one estimate $95 billion a year, which means that is a tax increase on folks of $95 billion a year. So it's not oh, well, this issue was handled by AMT anyway. No, this is actually catching a lot of folks, as evidenced by this estimate. So in light of residents in primarily high tax states, i.e. blue states, the state government started coming up with various proposals to help their residents get the benefit of being able to deduct their state and local taxes after the Tax Cuts and Jobs Act. And there were a few different proposals. We don't have to talk about them all because we're just going to talk about one today. But it's important to note that why has pass-through entity taxes gotten so popular? Why did this one, out of all the different solutions, carry the day, seemingly? And the answer is well, it was essentially blessed by the IRS in a notice that was issued in November of 2020. And the notice, I'm not going to let's be clear what the notice said. And the notice is saying that an income tax imposed on a pass-through entity is deductible and included in their non-separately stated items. So in other words, the K1 that you receive from a pass-through entity, in box 1, you have your income and loss from that entity, where that is your non-separately stated item. And, whether or not, these were the big questions. Well, what if it's an elective tax? What if the entity has to elect into it? Would that still be considered a tax, or does it have to be mandatory? And what if the partners are getting a credit for the tax paid by the entity? Is that really an entity level tax, or is this sort of in substance just like a withholding tax paid by the partnership on behalf of its partners? These were the big questions that sort of prevented the floodgates from opening and states enacting a whole bunch of pass-through entity taxes as the SALT workaround. But when the notice came out in November and the IRS is seemingly blessing a tax that is structured in this manner, it really opened the floodgates for state governments to say, well, we should do that to help our residents because they're getting arguably disproportionately hit by this SALT cap. And it's revenue neutral to the state government because it is a federal deduction that they're losing. And without it, many folks are going to move to lower tax states. So now New York was one such state that enacted a pass-through entity tax, April of this year. And my colleague Chris Moran is going to walk through the mechanics of that pass-through entity tax.
Thanks, Mike. So the pass-through entity tax applies to pass-through entities. And what are those? Those are going to be your partnerships, so multi-member limited liability companies that are taxed as partnerships, limited partnerships, general partnerships, and also S corporations, even if they only have a single owner. That's pass-through. So that's what the pass-through entity tax applies to, and how it works is the pass-through entity pays an entity level tax, as Mike has been discussing, at the same New York personal income tax rates on the income that would have been subject to New York personal income tax by its owners. So what does that mean? It means that New York source income is subject to the pass-through entity tax. So that could be a mom and pop restaurant operating in New York State. It's going to be all New York source income. It could be a limited liability company with out-of-state owners that sells goods into New York. That could be in New York. That could well be New York source income. A company providing consulting services to people located in New York State, that could all be New York source income. And then also income allocable to New York resident partners and shareholders. So for some limited liability companies, in sort of the easy example, all the income derived by the pass-through entity is going to be subject to this tax. In some cases, you're going to have different pool. You're going to have some income that's subject to New York tax and some that's not. In the case of a pass-through entity that's operating in multiple states and has resident partners or shareholders that are not all New York residents. It used to be that a C corporation was really the only type of entity that would be used for multi-state businesses, but increasingly in the last 10, 20 plus years, pass-through entities are used to conduct multi-state business. And the pass-through entity, the tax rate is going to be the same that the individual owners would pay on the New York source income or the income allocable to New York resident partners or shareholders. And that's just to create as little friction between the pass-through entity tax and the taxes that the individual owners would have paid on the income flowing through. The credit, the pass-through entity, so there's the pass-through entity tax, and then there's the offsetting credit. And the credit's allocated among the pass-through entity owners in the same percentages in which the income that's taxable in New York would have been allocated to those owners. And we'll get into an example in a little bit. The allocation can be a bit tricky if we're talking about S corporations as opposed to partnerships or LLCs. Some of these rules can be a little tricky, and we'll see that as in some of these following examples. And then I'll go over briefly the mechanics of how the tax act is actually paid. So we get it's elective on an annual basis. So each year you can make a year-by-year election. If you make it in 2021, you don't have to make it in 2022. But once you make it in 2021 or 2022, you can't revoke it for that year. So making the election triggers an obligation to make estimated tax payments. In 2021, the deadline to make the election is October 15th. So that's about a little more than 3 weeks to make is the deadline to make the election. And then to receive the federal tax deduction, so to benefit from the PTE workaround, the entity has to make payments of the PTE tax before the end of the year. So the tax has to be paid by 12/31/2021 to get a benefit in 2021. And here's sort of a tricky part: is the partners or shareholders of an entity that elects to pay the PTE tax, they have to continue to make the New York State estimated tax payment. So effectively, that means the individual partners and shareholders are going to pay their New York State income tax liability twice, because first they're going to make their individual estimated tax payments, those quarterly ones. 3 of those should have been made already, but then they're going to have to pay that liability again by 12/31/2021 to get the benefit. So again, the individual partners and shareholders will get that back when they file their return, but that the individual 1040 for 2021 might not be filed till October. So that's something to consider if the business is in a tight position cash wise, that this might not be great for 2021. But beginning in 2022, partners and shareholders will take the amount of the potential PTE tax credit into account when calculating estimated tax payments. So in 2022 and beyond, the partners can reduce their estimated tax payments by the PTE tax the entity pays on their behalf. So that reduces the sort of the friction in 2022 and beyond between the PTE tax credit and that's sort of the normal way of doing business, where the income flows through to the partners and shareholders and they pay their individual estimated tax payments. And with that, I'll briefly bring it back to Walter to talk about some of the important distinctions between S corporations and partnerships.
So I consider this slide one of the most important slides in our whole deck when you're in the process of evaluating whether a particular entity should elect into the New York pass-through entity tax. And I say that because to me, in the vetting process, there are really 2 big gatekeepers that I largely look to. One is not this slide. It's rather whether you've got any non-residents and whether those non-residents are going to get a credit back in their resident state for this New York tax. That's piece 1. Piece 2 is this piece of the puzzle on this slide, which is sourcing, which goes to, if you do elect into the tax, what part of your taxable income is actually going to be subject and get the benefit of the entity level tax for the benefit of your owners. And you delve pretty deep into the sourcing rules of state income tax law to get to this answer, but you kind of got to go there once you get beyond the simple fact situation. And the simple fact situation, which really doesn't take a lot of thought, is a partnership with all New York resident partners. Because in that situation, all of the entity's income will be subject to the tax. But when you move beyond that and you have either non-residents in the mix or an S corporation in the mix, then you do have to head down the sourcing analysis to determine in the future or for the year of election, is there going to be any taxable income actually sourced to New York and subject to the tax? And very briefly on how sourcing works, at least for entities. For entities, you look to the total pot of taxable income, generally what comes off the federal return, and apply some formula in each state. In New York's formula, it generally throws income into or out of New York for tax purposes, depending on where the customers are, where the market is. New York State uses what's called single source market sourcing, single factor, sales factor market sourcing. And what you see on the slide here is that, to make it even more complicated, different rules apply to partnerships in New York than to S corporations. For partnerships, what is meant to be both these are meant to be favorable rules to us in implementing this system, but for partnerships, you look to your resident owners, and if a resident owner has $100 being their share of the income, all 100 goes into the taxable pot and will get the favorable benefits. In contrast, for that same partnership, if it has a non-resident with $100 of federal taxable income that will come on its K-1, but the apportionment formula for the entity says only $40 of that income is New York source, then only $40 of that owner's taxable income will go into the pot. So for those two owners, you would only end up with $140 out of $200 total subject to this tax. So that's why sourcing is important. It helps figure out what's totally in the pot subject to tax. S corporations take even a different tact, making it that for all owners, it is only New York source income. So in my example before, total of $200 of New York source income between the resident and the non-resident owner. With the 40% sourcing factor, only $80 of that total 200 actually gets subjected to the tax, even though the owners may be electing, thinking, gee, we've got $200, it's all going to get the benefit. The sourcing rule here says no, for the S Corp, only $80 gets subjected to the tax. Surprise, surprise, if your professionals didn't vet that in advance for you. So in brief, and particularly with S Corps, the sourcing may negate the benefits of the election. Chris, I'll throw it back to you there.
And I'm going to walk through an example of how the PTE regime is going to work for a partnership with four individual members and one corporate member. So our partnership here is Bill's Mafia LLC. Extra credit if you know the last names of the individual partners. But some of you will, some of you, this example might be lost on you. So our partnership here has $14 million in New York source income. It's selling folding tables in Orchard Park. $14 million, we have partners getting 15%, 25%, 20, 30, and 10% interests. So we have $14 million of PTE to work with. So we have $14 million of income to work with. We have PTE taxable income is $12,600,000. So we have one corporate member, Zubaz Inc. And the corporation, the pass-through entity, entities that can benefit from the pass-through entity workaround are only individual partners, trust and estates. The corporate partner can't benefit from the pass-through entity workaround. So the corporate partner's 10% share, that's 1.4 million, is not eligible for this PTE benefit. So we have $12,600,000 of PTE taxable income. We have a tax of about 1.22 million. And we see how that reduces the federal taxable income to about 12.8. And here's how we're going to allocate the credits. So the residents, that's Jim and Bruce, are New York residents. And so you see that there's $5.6 million of PTE taxable income among them. Jim has the 2.1 from Jim's share of the partnership income. Bruce is 3.5. We allocate, that's 5.6 total, 37.5 to Jim, 62.5 to Bruce. We see their shares of the credit there from the resident pool. Next, we calculate the New York source income pool. That's going to be $7 million split between Andre and Thurman. Again, as we discussed, the share, the 1.4 million share to Zubaz Inc. is not eligible for the credit, so that's excluded. The non-resident share is about $670,000 that gets allocated between Andre and Thurman. And this is where we get a little complicated. So if we just allocate, if the PTE credit is allocated pro rata based on the partner's interests, we see how we have a mismatch between the share of the PTE credit and the reduction in federal taxable income, because if each partner gets the share based on their pro rata interest, then they're not going to get we're going to have a little bit of a lost reduction in federal income. So effectively, some of the benefits from the PTE tax workaround are reduced, because we see there's Zubaz is 0 share, so it's reduction in federal taxable income of 1.2. Then it's essentially getting a benefit, even though there's not any pass-through entity tax paid on its behalf. So that's where we have this mismatch. So what's the cure for the mismatch in the credit? The cure here, we see, look, we allocate the credit among the individual members. So now we have a match. See, there's the 1.2 million, 1,209,300 at PTE credit, 1,209,300 at reduction in federal taxable income, and we see the columns Thurman, Andre, Bruce, and Jim, their share of the PTE credit and the reduction in federal taxable income. Those match for each of them. So with that, I'm gonna go back to Mike to talk a little bit about the partnership agreements and how the allocations and distributions work, and some of the key things to look for to make sure that the PTE payment matches the deal economics. Because as we saw going back in slide 17, if there's no special allocation, the PTE payment is not going to match the reduction in federal taxable income. What we have is Zubaz Inc. getting disproportionate benefit, even though there's no PTE credit paid on its behalf. It's seeing this reduction. It would have this reduction in federal taxable income.
And,
Yeah,
Mike,
so,
I think I was going to jump in and do this slide.
yeah, go for it, Walter, and I'll just chime in if there's anything else to add.
So in part, what you just saw goes back to where I last left off, which is the sourcing topic, in that what you can have is, in particular, where you've got a resident and a non-resident owner, they may end up with different consequences. Your resident owner may well get attributed, and I'll put this in fairly simple terms from where the slides were just a minute ago. You may have a situation where a resident owner's share of the tax is $10 and a non-resident share is $5 because of the way the sourcing rules work. And when you lump that together, there's $15 of total tax. And in your usual partnership drafting for a partnership or LLC agreement, it would have just said those equal partners, 50-50 partners, would share that tax 50-50. They would each get $7.50 of the total of 15. But that's not what was intended in the tax itself, which is that your resident gets the $10 and the non-resident gets the $5. So we've had wonderful people in the legal profession draft these agreements that may need to be revisited, both in terms of how the actual item of expense, the tax item, gets allocated among the partners, as well as how the actual cash distributions get allocated. Because in my example, if the entity had $100 of taxable income, it should be that the resident gets his taxable income reduced by $10 and he's got $90 of cash to which he's entitled, while the non-resident member, $100 of taxable income being his share, had only $5 attributed to him. So he will be wanting his $95 of net cash available for distribution, matching up with the tax calculated at the entity level. All of which is to say from this slide that with respect to partnerships, limited liability companies, revisions are likely needed to the operating agreements in connection with electing into the tax to make sure that the actual allocation and distributions follow from the results that are intended originally, but with a tax structure that doesn't give equal results to equal partners. The other big piece to note is that this doesn't apply to S corporations. What we think the state was doing in providing a different treatment for S corporations, in saying that everybody got treated alike, was protecting ourselves from ourselves, in that if the statute was implemented like partnership law, or like the partnership piece here is implemented, it would mean that otherwise equal partners, a 50-50 shareholder relationship, would have different results for those shareholders, raising the concern that for federal purposes, you had different classes of stock, different economics, different allocations, different distributions, and therefore violate the federal law, single class of stock rule for S corporations. And so all of this forcing us back into commonality treatment-wise for S corporations helps us from ourselves defaulting on the federal level S corporation one class of stock rule. So you don't have the issue with S corps you have with partnerships of trying to realign allocations and distributions. And flip back to, I don't know, is it Mike or Chris, whichever you's up.
Okay. Yeah, thanks, Walter. And just to announce the CLE code, SALT 2021, one word, so no space between SALT and 2021. And so, yeah, just to comment just a little bit more on this slide, that is, you with LLCs, you may need to review the LLC agreement to make sure your allocations and your distributions work, especially if your credit is not going pro rata. The point of the program is that folks are instead of getting the deduction, which they lost because of the cap, so the lost deduction is being replaced with a reduction, which should be a reduction in the income on their K1. So the K1 amounts need to be reduced by the amount of the credit that they would otherwise get. And so if you go back to this example where we had some former Bills players that are non-residents and other residents, well, the amount of their credit is going to be a function of how much New York income tax they owe, not a function of their interest in the company. So you have the credit going sort of in one direction, but the deduction potentially going in a different direction. And in order for all this to harmonize, you got to make sure that the deduction goes follows the credit, so that everything matches up, and that these folks basically, get a K1 showing reduced taxable income, essentially as if they had been able to get a full deduction for their state and local taxes. Again, if everyone's a resident, or if it's only New York source income, it may not be a problem. But when you have these mix and match scenarios, and some people are getting a disproportionate amount of the credit, you got to make sure that all the allocations work, and that the cash distributions are drafted in such a way that no one is getting sort of an advance, like an advanced distribution, that really this is treated almost like a withholding tax, and that their cash out of the LLC, should be adjusted to take this into account. Or in other words, you should treat this as an advanced distribution that reduces their distributions they would otherwise be entitled to, because you don't want this tax program to screw up the economics of the deal. So just things that you need to think about if you're going to have rep a client, or you are an owner of a pass-through business that elects into this program. You can't just think about SALT, and you got to think, okay, how is the SALT matching up with the federal tax consequences? So now we're going to shift to some of the more practical considerations. Having a basic understanding of how the program works. Let's think about funds. Funds operate through pass-through entities. They have a lot of pass-through entities often. But let's look at a basic fund structure. And we have, oftentimes a fund will be a Delaware limited partnership. That's a pass-through entity. The LPs, or the investors, put money into the Delaware limited partnership in exchange for an interest in the fund. If they're U.S. taxable investors, typically those are your high net worth individuals, and they're going to be resident of who knows where, any state, Florida, California, New York, a potpourri of investors. And for your tax exempt and foreign investors, oftentimes a fund will set up a blocker because these are your ECI and UBIT sensitive folks. They invest through a corporate blocker. And so, as Chris mentioned with Zubaz, shout out to Zubaz, that the corporate member of the pass-through entity gets carved out in this analysis. You're only looking at the direct owners, the individual owners of the business. So if you were to compute the pass-through taxable income of the funds, jumping ahead a little bit, you do not consider the corporate member, which is what Chris mentioned before. So that's your LP side of the equation. Your GP side of the equation, these are your principals, come in through oftentimes its own LLC or their own LLC, which holds the GP interest in the fund and is often entitled to a carried interest, a percentage of profits after return to capital, after some sort of rate of return. X percentage of profits will flow to the GP entity. And there's also a GP commitment that'll be run through this entity also. So it's not just a carry, but it's sometimes carry plus the capital interest reflecting their GP commitment. That is also pass-through entity. Should we make the election there? We're going to talk about that. But there's another pass-through entity in a basic fund structure, the management company. The management company often has parallel, sometimes identical, not always identical, depending on employees coming and going. But the management company is a separate pass-through entity, also owned by the partners or principals of the fund, that receives the management fees. This is done for primarily New York City unincorporated business tax reasons, a different SALT issue, but that is why you usually see a separate flow-through entity or pass-through entity for the management fee income from the carry. So you're bifurcating those two income streams, and the only one of these income streams is New York source. Which one? Sort of gave it away by showing the physical address. Well, one has a New York address, the other doesn't, and simply owns investments. Well, that's the GP vehicle. But for the management company vehicle, the management fees are from services rendered in New York City. In this example, they have a Manhattan address where folks go to work every day, or they used to before COVID. And there was New York source income running through that entity, in contrast to the intangible income from the sale of a portfolio company that would be routed through the GP aggregator. So this is what a fund typically looks like. And how do we think about this pass-through entity tax regime, applying to this? What do we do with that? So, well, let's just look at each one, because for you have the option to make an election with respect to each of these three entities, not the blocker, that's a corporation. Okay, the first one is the management company. On these facts, and admittedly they're overly simplified, but it's, this is sort of the foundation from which to do any analysis. Is you're in this example, you have folks that are resident of New York and Connecticut. And that's probably going to be the case. You have owners that live anywhere, say in the tri-state area. And the management company, as we mentioned, has New York source income. So what happens, would it make sense for this entity to make the election? Well, on these facts, it probably would, because as Walter was talking about, when you're an LLC, in contrast to an S corporation, you get to include in taxable income, and this is sort of a bizarre concept, including something in taxable income is good because it means that income is eligible for the credit. You normally don't think about it that way, but you want as much income to be eligible for this pass-through entity tax, because then your owners can get a credit for that tax. So you're sort of in, the upside down world where you want the income to be passed through taxable income. And in this case, it's an LLC. So, and it's all management fee New York source. So 100 cents on the dollar or 100% of the income running through this entity would be eligible for the credit. We know that the New York owners can get a credit in New York because that's how the statute reads. And the Connecticut folks, as Walter was talking about before, if you're going to make this election, you don't want to screw over non-resident owners of the entity that are in a state that doesn't allow the credit. But because in this example, it's a small universe with just 4 folks, 2 New York, 2 Connecticut, you can be comfortable that the Connecticut folks are also going to benefit. They're going to get a credit on their Connecticut resident return for the entity tax paid by this management company. So that would seem like a reasonable thing to do, or like it would make sense to explore making the election there. The GP entity on these simplified facts has the carry. It is not, as we mentioned before, this isn't New York source income. So the only folks that could benefit here are going to be the residents. The Connecticut, this is sort of one of the points of setting up the structure this way. The Connecticut partners, since this is intangible income from the sale of, say, portfolio companies, it's not sourced to New York. Even without the SALT cap, these Connecticut residents are just paying capital gains on their exit in Connecticut, because that's where intangible income generally is sourced. But for the New York folks, they would benefit from making the election here, because even though it's not New York source income, it's sale from investments, that the pass-through taxable income includes anything that is going to a resident. And so if you make the election here, presumably those 2 New York partners could benefit from the credit approach. Lastly is the fund itself. And this is where it gets complicated. And frankly, we have not seen many funds make the election for the various complexities, which are where are your investors a resident? Are they individuals? Simply because someone is investing through an LLC, it could be a disregarded LLC, so that it's really an individual owner who should be eligible for the credit and taken into the account in doing the pool. Or maybe they're not a direct owner. Maybe their state of residence changed during the course of the year, so that in doing the computation for the first half of the year, you're doing it one way, but then it switches and they're not notifying you that it switched. As Walter mentioned before, you have investors that are probably residing in many states, and some have the reciprocity for the credit, but there are many that don't. So while you could be helping some investors, you may be hurting others. It's a very difficult administrative computation, just given the just opaqueness into the personal tax situation of the investors, which makes it difficult to do it to sort of match up the pass-through entity tax with the personal liabilities of your investors, plus the potential of harming certain non-resident investors, non-New York resident investors, if they reside in a place that does not have the reciprocity for the credit. And presumably for this reason, and Walter, I don't know, chime in if you have a different viewpoint, but for those reasons, funds have not elected into this regime. It's a new regime. There are a lot of complexities and uncertainties. And I think they're sort of saying this is a personal tax problem. If you want to solve it, work with your accountant and solve it. And the next slide is going to touch on that, which is, well, if my fund isn't going to help me out by making the election, either I'm a principal and the higher ups to the fund aren't willing to make the election at the management company level or at the carry level. I'm just a VP, and I don't have the sway at the firm to do that. What can I do? Or you're an investor and the fund saying, no, it's too complicated. We're not gonna help you out. Well, there is an option potentially to drop your ownership interest into a regarded entity that you own with someone else. Most logically, that could be a spouse. Now you have the option, which is you don't have to ask anyone else to do it. It becomes your entity. You can make the election and say, okay, with respect to this, husband-wife holdco, I'm going to make the New York pass-through election. And therefore, I'm going to pay an entity level tax, which then I can credit against my New York resident return. Right now, we believe that there is a reasonable basis for this. There's no need to have a 162 trade or business at the entity level. There's reading how the New York statute works and how the IRS notice works. It is simply an income tax paid by a pass-through entity. That would apply to if you drop an investment asset into a pass-through entity. That is an income tax, a state income tax, paid by a pass-through entity. Now, we don't know what the IRS guidance is going to say. We don't know when we're going to get IRS guidance, but in the meantime, based on the notice and how the New York statute reads, that we have seen folks do this, and there is a reasonable basis for doing it. It makes sense based on how the statute and the notice reads. So that and the last point to note, if you are moving an LLC interest, oftentimes LLC interests will have certain restrictions on transferability in the LLC agreement. So you may need to obtain the requisite consents to restructure your affairs in this way. So just note that point. So those are the planning considerations for fund managers. And I'll just note one more thing. As Chris mentioned, the election is made annually, and it's made at the start of the year. So if you're a fund principal and you think there's going to be a big exit event, you foresee a big exit event, say in 2022, well, you need to be on the ball to make the election by March of 2022, before the exit event, to plan in time for basically the income to be eligible for this pass-through entity tax. You can't wait until the end of the year or after you've sold the company and say, oh yeah, this was a great result. Hey, well, how come I never made that? I could have just made that election. Why didn't I do that? Well, there's no late relief. You have to be proactive in thinking about the situation. And so, if you have a carry and you don't think there's going to be significant income, okay, maybe it's not worth the hassle. But if you're anticipating, a big slug of capital gains, and it seems like low-hanging fruit not to attempt to avail yourself of this program, which, as mentioned earlier, is supposed to help New York residents, relieve them of the burden of the SALT cap. So that's just one point there. So I'll turn it over to Walter to talk about a different industry, the entertainment industry, talent working in the entertainment industry, actors, writers, producers, directors, things that those folks should be thinking about.
Yeah, and I'll try to move through these remaining slides fairly quickly so we try to have a few minutes for questions and answers. Chris and Mike, you may want to see some of those questions so we can be ready to take a few minutes for them. Yeah. So this example here that's focused on the industry, talent, entertainment industry, really has got a broader ramification to it. It really deals with S corporations generally, and the situation which really you cannot end up worse off than you were if you didn't make the election. This is a good example of very carefully vetting whether to make the election. And the context is the S corporation side of things. And it's set in sort of the entertainment mode where you often will have an S corp with its owner cleaning out the income at year end by compensation distributions, W-2 type distributions. So the taxable income for the entity is, call it zero in our example here. And as a result of that, a switch would have to be made in the compensation mechanism to undo that for the year, or not undo it, but not to clean out the compensation at year end, but leave it in. thereby having taxable income to which the election could apply. And again, this is sort of in a loan out mode of the actor based in California. He works for his S corporation. The S corporation works for the Los Angeles studio. The actor comes and performs on site in New York City and has the option, as election time rolls up, to decide whether that compensation that his S corp has been paid comes out to him or not. And this is where, unfortunately, we go back to the sourcing rules and how New York gets about as messy as it can be. And on the one hand, you can really get whipsawed here because you may well decide not to pay the compensation out, thereby increasing the S corp's taxable income. Good result for our election. But when you apply the state level sourcing rules, you may well find that the sourcing throws that income back to California, where the customer is based on market sourcing. So even though you have boosted the federal taxable income by not taking the compensation deduction for the year, hoping or anticipating that you are creating income eligible, the state level sourcing rules may throw that income out of the state, so you don't actually have taxable income. New York City really throws a wrench into it because they don't respect, for city taxation, S corp status. So you have a taxable entity. As noted here, it's got nearly a 9% tax rate on the taxable entity. And the sourcing rule is an entirely different sourcing rule for New York City S corp taxation. It's going to source based on where the work was done. So if this actor actually did the work in New York City, that income may in fact end up being subject to the New York City S corp entity level tax. That is not a tax for which the owner gets a credit. So it's not getting you the same type benefits that the elective tax gets. So you've really ended up in the worst of all situations. It's not to say you would necessarily, it's just say this is the type of vetting you need to go through to evaluate how the sourcing rules apply in the S corporation context. And in particular, this has application often in the entertainment industry. Let me slide on, Mike. Why don't you move us on to the other state topic real quick there? I'll do a quick breeze through that. So a general theme across the country is often when states come up with a wonderful new idea, they will copycat each other. And Massachusetts will adopt a law and Connecticut will look at it and say, oh, that's neat. We'll piggyback it off us. And enact legislation very similar. That has not happened in this area. These statutes, truly, each state has tended to go their own way. They are markedly different. You can't assume that what New York would, consequence you would get would be the same as in California or the same in Maryland or Virginia. The statutes are just different. And here are some of the ways they're different at perhaps extremes. Very quickly, are some mandatory? Well, the only one I know of is Connecticut is a mandatory tax, no choice. At a different extreme is California, where you can actually have each owner elect separately whether they want to have their share of the income be subject to tax. New York is kind of in a middle zone on that in making it elective, but elective at the entity level as a whole for particular taxpayers. The way the add back occurs, all states are going to have some way that the taxable income itself gets added, the tax deduction at the entity level gets added back to taxable income for the individual. For the most part, it's like New York's, it's a straight add back. Some states, again, Connecticut being an outlier, they actually have a mechanism where Connecticut takes a piece of the pie itself, almost like a fee that is built into the way they implement the add back. Applicable owners differ. Many states will typically sort out that tax will not apply to that portion of the income attributable to nonprofit organizations, corporations. Typically will have it apply like New York does to individuals and trusts, but there's quite a bit of variation along the spectrum there. The next slide's got sort of the two big topics I keep coming back to is the vetting topics. Mike, you might slide along there, one more slide, which are the apportionment or sourcing topic. And as Mike spent a few minutes alluding to in his example, the other state tax credit. Very important to whether you even want to go into this regime of New York's pass-through entity tax. Mike, why don't we slide on to questions and I can quickly address the couple that came in previously. And then we'll go on to some that just came in. A couple that came in previously, if the election is made and the paid by 12/31, can individuals pass up on making their fourth quarter estimate? The simple answer is no. The New York tax, estimated tax for 2021, just for 2021, this is strictly speaking to 2021, doesn't require the tax, any level tax, to be paid until March. The state did not want to miss out on actually getting timely tax payments in, so it requires individuals to proceed with making their estimated tax payments, even regardless of when the entity level tax goes. Don't know how it's going to show up on the forms, but presumably the forms will implement that in some way, that the credit for the entity tax comes after reconciliation of the estimated tax payments. The one major footnote on that is, despite the March date of the state tax, if you elect in, as a practical matter, you're going to have to pay the tax by the end of the year in order to actually get the deduction for 2021, because virtually everybody who's in this is a cash basis taxpayer. So the March payment date's really sort of an artifice out there. December is really the date you'd have to make the payment. Can a CPA firm set up a business account and pay the past 20 tax on behalf of clients? And the second piece is, does the easy rep form provide any authorization to make the election? One of my colleagues here at Venable, Jane Chung, did a very nice job of reaching out to the state and probing on this, and got an answer that if she hadn't done that, I would have given a different answer. And the answer is that that we as representatives can't ourselves set up the business account. The taxpayer needs to do that, but they can link it to our professional account. And once they've done that, we can then make the election on their behalf using the easy rep form or process. So that is a yes there, that you can go through that. Again, the taxpayer has to be the one who actually sets up their own business account, at least according to the state person, the way it's got to work. But then once they provide authorization, the authorized party can handle the election in. Want to swing back, Mike or Chris, if we've got other questions, we can quickly hit.
I think,
Chris, legislation, yeah.
Yeah, Chris, if you want to touch on the legislative update, where things are going, and then I think we'll circle back separately to the folks that submitted questions during the course of the presentation and get answers to those folks. But I think we're running up against the end here.
One big question I did see is, will the slides go out? And the answer is yes, the slides will go out in coming days. Those will head out after they get cleaned up.
Okay.
So on the legislative front, without any legislative action, the SALT cap is scheduled to expire on December 31, 2025. And a number of states have tied their PTE workaround to the SALT cap, saying their PTE workaround expires December 31, 2025, or if the SALT cap is repealed, it expires then. I think even if the SALT cap expires, there are taxpayers that could benefit from PTE workarounds because there are AMT savings. You don't have to, as Mike touched on earlier, the state and local taxes are added back on the AMT, so a lot of taxpayers only get a partial benefit from paying state and local tax deduction. The PTE workaround could give, even if there is no SALT cap, could give taxpayers a full benefit for AMT purposes. So that's definitely something to be aware of, that if your state allows it past December 31, 2025, the PTE workaround could still be good past that date. The legislation that the House Ways and Means Committee proposed a couple of weeks back does not repeal or expand the SALT cap. That item's still up for debate. Mike touched on it briefly before. Repeal is estimated to cost approximately $95 billion. So it's very expensive. There are some reports that saying that over half of the tax increases on the top 1% of income earners would be wiped out by repeal of the SALT cap. So I think that's going to make it politically very difficult to do a full repeal, even though there was a temporary 2-year repeal proposed last week. Again, just a caveat, the information on this slide is really only as good as, probably not even as I said it, maybe about a couple hours ago when I last discussed this with one of our legislative folks, because things are changing pretty rapidly. But my big takeaway is that even if the SALT cap is repealed or it expires, these PTE workarounds, if the state allows it passed, if the state allows it even when there is no SALT cap, there still could be benefits for taxpayers that are subject.
Okay, well, thanks everyone for participating or attending. We will circulate the slides as soon as possible and do our best to get back to those folks that submitted questions we didn't have time to go over. But yeah, thank you all for dialing in today.